For 2 decades, Turkey has been one of the world's most turbulent major economies, impressive real economy fundamentals repeatedly undercut by unusual macroeconomic choices. The headline problem is inflation. Since the new Turkish lira was introduced in 2005, it has lost roughly 96% of its value against the world's reserve currency. That statistic is even more alarming when you recall why the new lira existed in the first place. It replaced the old lira after hyperinflation. When a country resets its currency, and then spends the next 20 years eroding confidence in the reset, households, firms, and foreign partners begin to see inflation not as an accident, but as a systemic feature. To be clear, the comparison point isn't benign either. The US dollar itself has lost a substantial chunk of purchasing power over that period. If the dollar slid and the lira collapsed relative to a sliding baseline, you get a sense of the severity and persistence of Turkey's inflation shock. In principle, recent policy shifts should have helped. After years of insisting on low interest rates in the face of rising prices, Turkish authorities have finally raised rates aggressively. In theory, that stabilizes the currency, cools demand, and resets inflation expectations. In practice, so far, it hasn't worked. Some of that is timing. Once expectations de-anchor, they're hard to re-anchor. But much of it is structural. After 2 currency failures in a generation, convincing a highly literate, commercially savvy population to hold wealth in lira and price in lira is a monumental task. People dollarize, or euroize, their mental math. They renegotiate in foreign currency, stash savings in foreign currency, and, whenever possible, borrow in a currency they trust. The tragedy is that beneath these macro theatrics, Turkey retains the makings of a formidable economy, a large and skilled workforce, strategic geography between capital-rich Europe and resource-rich Eurasia and the Middle East, deep industrial capabilities, world-class tourism and medical services, and a unique ability to play bridge in a more fragmented global order. If it could get the money plumbing right, it could be a winner. To understand how we got here, it helps to rewind. In the early to mid-2000s, Turkey was among the fastest-growing economies on Earth. The country strengthened its central bank independence, explicitly tasking it with price stability, then it redenominated the currency, lopping 6 zeros off the old lira. Those moves did 2 things. First, they signaled that inflation control trumped short-term politics. Second, they simplified transactions, contracts, and accounting, important for credibility with both locals and foreign investors. The textbook mechanism is straightforward. When inflation rises, an independent central bank hikes interest rates. Higher rates discourage borrowing and reward saving, reducing money in circulation and cooling prices. Painful? Yes, credit slows, businesses feel it, unemployment can rise. But credible independence gives a central bank permission to be unpopular for the long-term good. For a time, it worked. From 2001 to 2013, output more than quadrupled. Turkey migrated from agriculture toward mid to high-end manufacturing, construction, and finance. Its location paid dividends. Pipelines, shipping lanes, cables, and trade corridors tied Turkey into both European demand and Eastern supply. It became a facilitator, earning fees and influence by connecting blocs that increasingly didn't want to talk to each other directly. Finance flourished as well. A currency you can trust is the foundation of banking. As confidence rose, banks expanded household and corporate credit to ride the boom. Public finances looked manageable, leaving space for countercyclical support if needed. On paper, Turkey was assembling a durable platform. But even during the boom, the lira kept sliding. The central bank lowered policy rates to support growth and resisted hiking as the currency weakened. A mild, controlled devaluation isn't necessarily bad. It can help exports and shift spending toward domestic goods. The trouble is the composition of borrowing and the direction of capital flows. With near-zero interest rates abroad after the global financial crisis, Turkish firms and investors borrowed in foreign currencies, cheap dollars and euros, then invested at home. Private sector FX debt swelled. When those loans come due, someone must buy foreign currency to repay them, selling lira in the process. Meanwhile, Turkey ran a trade deficit, importing energy and capital goods. That meant a structural need for foreign currency on top of debt service. Net effect, a market with few natural buyers of lira and many sellers. Foreign investors could sidestep some currency risk because the Turkish private sector itself was issuing or borrowing in foreign currency. Instead of buying lira to invest, many could hold dollar to euro claims on Turkish entities, less FX conversion in, plenty of FX conversion out. The central bank faced a bind. Raising rates sharply might have slowed domestic borrowing, but it could also have worsened currency mismatches and pushed more borrowers into foreign currency, or raised debt service stress on those already exposed. Compounding the problem, a significant share of credit was flowing into unproductive assets like real estate rather than tradable sectors that generate foreign currency earnings. The economy looked hot, but the dollar and euro balance sheet underneath was getting fragile. Politics then magnified the fragility. The 2016 coup attempt and its aftermath spooked capital. A 2017 referendum concentrated more power in the presidency, eroding checks on policy, including monetary policy. Investors price institutions, not just interest rates. As the ability of technocrats to act independently became questionable, risk premia rose and capital slowed. The lira's slide accelerated, inflation surged from a chronic irritant to an acute crisis, peaking at eye-watering rates. At the center of it was a simple, damaging pattern. When central bank leaders tried to hike rates to restore credibility, they were removed and replaced with leaders who kept rates low. Markets learned the lesson. Policy would stay pro-growth and pro-credit even as inflation ripped, so the rational response was to run from lira exposure. Ideologically, the low-rate stance was defended on two grounds. First, the classic, weak currency boosts exports logic. In practice, Turkey isn't an export juggernaut with persistent surpluses, it imports a lot of energy and intermediates. A weaker lira raised input costs, squeezed margins, and fed inflation faster than it boosted net exports. Second, a moral claim that interest is usurious. Whatever the theology, this removes a vital stabilizer from the toolkit. Without credible rates, you're left with capital controls, administrative guidance, and ad hoc interventions, none of which build durable confidence. Recent moves have reversed course rhetorically and partially in practice. Policy rates have been lifted, dramatically. But two frictions blunt the impact. First, broad money is still expanding, with banks channeling fresh credit to businesses who, rationally, borrow even at high nominal rates if inflation exceeds interest, a negative real rate that pays borrowers to take money. Second, well-intentioned schemes to defend savers backfired. A high-profile FX index deposit product promised to compensate households for lira depreciation. If the lira fell 50%, savers received a 50% top-up, effectively printing lira to offset the loss, which then fed more inflation, which then demanded bigger payouts. Authorities have since wound down the scheme, but the episode illustrates how hard it is to engineer confidence with financial band-aids rather than macro credibility. So what would it take to bend the curve? In essence, rebuild trust in money and realign credit with productivity. That means empowering the central bank to target inflation credibly, and be believed, even at the cost of a slower near-term economy. It means cleaning up the FX balance sheet, lengthening maturities, encouraging local currency intermediation, and letting zombie credits fail so capital can reallocate. It means resisting cosmetic fixes that create contingent liabilities on the sovereign when depreciation continues. It means refocusing credit on tradables, exporters, advanced manufacturing, logistics, so that new debt is serviced in hard currency by design, not by hope. And it means being honest with the public. A currency is a social contract. If everyone believes the lira is a good store of value and a fair unit of account, it becomes one. If they don't, it can't be legislated into being. The prize is worth the pain because Turkey's real economy is still compelling. Its labor force is young, educated, and cost-competitive relative to Western Europe while more skilled than many neighbors to the east. Tourism remains a foreign currency engine even in tough years. Beyond beach holidays, medical tourism has become a high-margin niche where Turkey already excels. Its geography is priceless, a NATO member with deep ties to Europe, yet a pragmatic interlocutor with Russia and the Middle East and part of the EU customs union. In a world drifting toward friendshoring and supply chain hedging, Turkey can be the preferred middleman, the place both sides can tolerate. That role throws off stable fees, jobs, and leverage, provided contracts are predictable and the currency is not a moving target. There is also a longer-run tailwind. Major institutions still project Turkey among the world's largest economies by purchasing power in the coming decades, reflecting population size, industrial depth, and location. Those projections are not destiny, but they hint at latent capacity. The machine is powerful, it needs oil. Money is the oil. If you enjoyed the video, do like the video and subscribe to the channel. Thanks. See you in the next video.